Hopefully you can see my screen. Just move the chat box out of the way. There we go. Okay. Let's just pop that down there. There we go. Right. Still just staying with the New Zealand yen for a moment. I'll hop over onto the currency array in a moment, but I just wanted to show you something on here. And we're maybe going to have a look at another pair. This is basically New Zealand yen on 3 minute, and there are trades that come along that really you can't fail to spot. I'm talking now from a volume price perspective. I mean, it literally jumps at you off the page. And what it also demonstrates is this is 7 o'clock our time, so this is the open of the European session. We talk a lot about the crossover session volatility and reversals which occur at the London Open, which is here at 8 o'clock. So you'll get all sorts of shenanigans carrying on there. But you also get them in the run towards the European session. And this is just a classic example. How can you fail to miss the dramatic move in volume? You had a candle here with volatility, fine. We then have another one, big wick to the lower body, but 1.5 tons of volume coming in. And then it's repeated again. So we know for a fact we've got a massive amount of buying. This is an anomaly. It's anomalous. Why is it anomalous? Because if this were going to be in agreement, in other words, if price and volume were in agreement, this candle should have closed somewhere down here with that amount of volume. In other words, a widespread down candle. It hasn't. It's closed as a narrow body with a wick to the lower body. And therefore, what that tells you loud and clear is this is buying. The big operators and market makers are buying into this. They're also buying again in here. And then off we go up to the upside. And in addition to that, you've also got these, we have this channeling effect going on. This is going back to 5 o'clock. So we were in a congestion phase, a lot of volume building. You can see the levels here on the accumulation distribution indicator on NinjaTrader, which paints these levels automatically in terms of their strength. This one's been tested 12 times. In other words, it's over the period of the indicator, it's tested and reheld. So it's a very strong region, either as resistance or support. Exactly the same with this level, pretty much identical in terms of weight. And the two of them together present a wonderful platform, a barrier once breached or tested or breached, whether it's passed through as resistance or acting as a platform of support. So once you've got that in below, I mean, it's a pretty straightforward trading opportunity, not only in terms of the volume analysis, but also in terms of where to place your stop loss. Because you're talking about a tight range here of 5 pips, maybe 10 pips between the two here. So you'd be putting it in here somewhere as a scalping trader below this level. You've got lots of protection in place, and then off we go to the upside. And it's a pretty straightforward trade. Now what we're seeing in terms of this chart, we've got the volume point of control, we're into congestion phase, and we're moving sideways right now, and that will be reflected. And the reason, part of the reason for that, going back to sentiment, just pull this over. This is the VIX. If you don't have the VIX up on your chart, if you don't have TradingView, you don't have it elsewhere, you can always find it on investing.com. Here we go. You can pull it up here. Here we are, the S&P 500 VIX. That's what you want to see. You want to see what's going on. Here it is in terms of the charting. So it's opened a little bit, gap down, and now it's starting to claw up a little bit. So what that's telling you in terms of sentiment is that risk on sentiment, which was pretty strong for the first sort of hour of trading, is now coming off a little bit. Doesn't necessarily mean it's going to reverse wholeheartedly. This is the daily. That's the daily chart for the VIX. You can see where we're going. We're still continuing to the downside. But in terms of an intraday perspective, we opened up down here. Now we're starting to tick up a little bit. So in terms of what is going on in the yen complex and the yen pairs, really, you're seeing that reflected in terms of New Zealand yen starting to come off a little bit. In other words, we're starting to see a little bit of buying coming into the yen complex. Just go over onto the currency array, which is here. Here we are. And I've isolated out the yen pairs for you to see. New Zealand yen is up at the top. We know that for a fact. It's been rising very strongly. This is on the 5, 10, 15 combo. And it just gives you a straight heads up. Because the yen is always the counter currency, it just gives you a straight view of sentiment towards the yen. Is it universal? And what's interesting when you look at it, you think, well, and you can start to see that ticking off now. As the VIX is ticking up, it's just ticked up a little bit more. And you will see that reflected in a flattening of these lines. You're starting to see a potential reversal come into play. And really and truly, that is just being delivered through the prism of sentiment. Of course, you're going to look at the CSI, because if you look at the multiple CSIs, and I just want to draw your attention to this one, the Swiss yen here, you think, well, why isn't that one doing anything? When you go to the currency strength indicator in multiple timeframes, the reason the currency yen has not developed a strong trend is for that reason, because the Swiss franc, the green line, has been falling along with the yen and indeed with the dollar. So those three currencies, I mean, they're pretty much intertwined, the three of them. So if you looked at any of that combination of currency pairs, they're not going anywhere. In addition, just to draw the same analogy, you could also look at the Aussie, the New Zealand, the Canadian, and the Euro, because they're all moving in the same direction. So if you looked at any pairs there, you wouldn't find much of a trend developing. It would be in congestion. But obviously what you then want to look at is, well, where are the trends developing? And you can then look at something like an Aussie yen, New Zealand yen, Euro yen, what have you. And it's a question of unpicking all this data the whole time. Now, if I pull the VIX back again, what are we seeing? Well, we're starting to see the VIX tick up. It's not roaring up, but nevertheless, it is ticking up here. It's moving up. It's coming off those lows. And that is just a reflection of sentiment. Intraday, it's not, you know, an investor in equity markets is hardly going to be bothered about what is going on a 1 minute VIX chart or a 3 minute VIX chart. They will be more concerned with what is going on in terms of the daily, and they will be cheered by the fact that the VIX is falling, and therefore, you know, the longer term sentiment, the risk sentiment, is likely to be rising. But from an intraday perspective, as a scalping trader or a slower term swing or trend trader, that is the information it's imparting to you. It's just so valuable. And that's without all the other information of bonds, bond yields, risk assets in general classes and everything else. So it's just a case of putting it all together. Let's just go back to the charts again, and let's pop that out of the way. There we are. And if we start to look at the chart now from just a price-based perspective, what is it we're looking at? Well, you know, what do you think this might be? Well, it's a 2-bar reversal. If you overlay one on top of the other, and if we step this down to a 20-minute chart, then what you've got there is a 2-bar reversal. In other words, the market's rallied and collapsed. So if you overlay that candle one on the other, you'll have a narrow body candle with a big wick to the upper body and plenty of volume. Now, obviously, the volume comes from the concept of coming through the London session. So we've always got to be a little bit cautious about comparing volume across the time horizons or across the session crossovers rather. But nevertheless, that is what you're seeing, and that's what you're constantly looking for. You're always looking for 2-bar reversals in all time frames. You'll see them everywhere. If we step down onto the 15-minute, there we go. We've got a similar picture setting up there. We had a little bit of weakness coming in, not huge. Tried to rally, then we start to see the reversal. And as I say, you then you overlay that picture of price action and volume against the sentiment picture. I mean, if we step down onto the indices, the US indices, and again, if you haven't got these on Ninja or you haven't got them on your MT5 platform or your MT4 platform, just head over to investing.com. You'll find them all there. But this is what's going on right now. This is the YM on the left. This is on 5 minutes. This is the NQ, which is the NASDAQ. This is the Dow. This is the NASDAQ 100. These are the futures for them, the E-mini futures. And this is the ES, which is the S&P 500. It's just a question of putting it all together. And what this also tells you from I was going to say a totally unrelated market, but from a market that most Forex traders would consider unrelated, what it also gives you is the perspective from a technical point of view in terms of where this price action is likely to pause. And when you look at this chart, this is as I say, this is S&P 500, so it's a direct link to VIX. you look at the technical levels, and what have we got here? Well, we've got another 7 or 8 points to go here down to this platform of potentially very strong support coming into play with these two levels. So if you're trading a currency pair and you're aware of that in terms of what is going on a 5-minute chart for the ES or the S&P 500, as I say, which most Forex traders would have no clue about, wouldn't even bother looking at, but if you look at that, it gives you another piece of the puzzle to plug into your analysis of where this is like to pause, where we're going to find potential support, and therefore the risk in terms of if you're trading this short now, going back into the currency markets, if you're trading that short, where is it like to pause? How much headroom have I got on the trade? Is it worth taking that chance? You know, do I want to get into this market, or do I just want to sit tight for the time being and not trade short? I'm just going to wait for the reversal to come in and a continuation into the longer term upside momentum. Just to pull this chart up on the daily and to perhaps pick up on Sanjay John's question about, you know, slower term timeframes. This is a classic example about the daily chart giving you information not only for longer term traders, but also in terms of context for intraday trading as well. It's a self-explanatory chart. You've got the volume point of control here. You've got these very strong platforms, very well defined to the downside, and a very strong ceiling of resistance defined to the upside at 66. So we have another 75, 76 pips before we get there. You can see the number of times this has been hit and failed. So it's a significant region. It's a significant region if you want to take this trade as a longer term. Traders, going back to what I was saying about the currency heat map, if you were looking at taking this on as a longer term opportunity, then you're going to be looking at the daily chart. You're going to be looking for all those areas of support, resistance, the volume perspective, what are the indicators telling you, etc., etc. But if this market breaks above 66, then I would suggest it's a good opportunity for a longer term trade. It's not a trading recommendation. It's just an analysis of the daily chart and what it's revealing at the moment. Let's just flick over to one or two others. Let me just go and have a look at, let's have a look at the Aussie yen. Probably a similar picture. Pretty much identical, in fact. Just load that up again. There we go. It's a 2-bar reversal. Now, in addition to viewing it as a 2-bar reversal, you also see it referred to as a bearish engulfing, which, you know, the principle is exactly the same. That's what it is. Or you see a bullish engulfing. In other words, the reverse, where you've got green over red. In this case, we've got red over green. But it's the same. It's exactly the same principle as just in reverse. But you'll find them all over the place. They're not infallible. You will get them, and the market will revert, will maybe congest and not reverse full blown. I've got another little one here, a little 2-bar reversal there, this time to the upside. So this is a down thrust, this is a hammer. Overlay that on that. What have you got? Narrow body wick to the downside, up it comes back to the body again. So you find them everywhere in all time frames, and they just help to give context. They help to give a view on what is happening next. Just head up onto this particular chart, just see where we're going. And in terms of if you were going to trade this as a short opportunity, the question you've got to ask yourself the whole time is, okay, if I'm going to short this position now, first of all, where am I going to place my stop loss? Secondly, how much risk am I going to have to put on the table? And where is this position likely to develop to before it hits some sort of problem area on the chart? This is a nice example. If you were looking at this as a short, from this region down to here, we've got 20 pips. Is 20 pips enough for you? If you're going to have to lay out, I don't know, maybe 10 or 15 to get a clearance above here, that may be way, way too much risk for you to in terms of reward. But where is the chart like? Where is the price action going to run into difficulty? It will almost certainly reach this level. If it gets through there, it's pretty easy because it's light in terms of volume support. There's no volume there to cause the market to pause. So it's going to slice through this fairly quickly. But once it gets down to this region, you've got 1.5 tons of reasons for it to congest. You've got the volume point of control, and you've got 3 pretty big levels here. So if the market gets to that level, you can be almost assured that it's not going to go straight through there. It'll congest. So in terms of taking the trade, Is 20 pips enough for you? Maybe, may not. But that principle is applied whatever you're trading in whatever time frame. It's very, very simple, and you're basically using the chart to give you the information as to whether the risk you're prepared to put on the table is sufficient for you to take that particular trade. Can I pass back to you, darling? No? Okay. Anna's just sorting something out on her screen. Let's just go back to the currency array for a moment. There we go. And that's what we're seeing right now. We're starting to see that easing off of sentiment. Just pull the VIX back over. That's what's going on at the moment. The VIX is still, it's not, certainly not falling. It's rallying a little bit. It's not rallying strongly, but it's not falling. So the fact is it's congesting but rising with some bullish sentiment. And therefore what we're seeing is the yen starting to buy. If we go back onto the CSIs, that's what we're seeing right now, and it's pretty much reflected. That's on 5 minute. This one is 10 minute, and this is over on 15 minute. So we're starting to see the yen being bought. It's being bought along with the Swiss franc. So we've got risk being bought in terms of the Swiss franc. It's rising with the dollar. So we've got exactly the same principle there, and here, and here. In terms of a longer term opportunity, you're seeing the New Zealand dollar roll over here. You're seeing it roll over here on 15, and you've got the extremes down at the bottom. And as I've said many times before, you have to decide what it is you want to do. And we've got the pound selling off quite strongly here now as well. It's got up to the top. It's now rolling over nicely. And a nice steep line. And the steepness of the line will tell you instantly about the strength of buying or selling in that particular currency. And what you're looking for all the time is you're looking at those opportunities where you have one which is falling strongly and another which is rising strongly. And where you get in will be up to you. Do you want to get in at the top here? As you know, many of you know, I just look at reversals all the time because I like to get in early. So I'm always up at the top or down at the bottom. I'm prepared to wait. I'm prepared to be patient. I'm prepared to set my stop losses wider to allow for the buffering, because no currency will ever roll over perfectly. It doesn't get to the top and say, right, I'm at the top now, I'm going to go to the bottom again. You'll get a lot of buffering, you'll get a lot of congestion building, and then it will start to move. So it's a question of being patient, and that being patient comes at a price, because you have to set your stop loss wider. You can't put a stop loss in of 5 pips and expect to be rewarded every time. You're going to have to set them wider, 10, 15, maybe even 20. But that risk on the table will ultimately be rewarded by the pair rolling over, which is what we've got right now. So you're getting into the trade early. Once the trade is underway, these trends will be developing now, certainly in terms of pound yen. Don't even need to look at a chart. Pound yen, pound dollar, pound Swiss, they'll all be moving nicely. The trend is underway. The train's left the station. If you want to get on the train, that's fine. It's moving. But your reward, you've already given up all that momentum that's been delivered from the moment the train started up and left the station. You've missed all that. That's gone. That's history. You've lost it. So you're getting in, you're jumping on, you're paying a lower price because the trend is underway, and you can set your stop loss that much wider. So you maybe can get away with a 5, 6, 7 pip stop loss, but the reward is lower because you've given up some of the trend that's already gone and it's historic. That's for you to decide. You'll find which works for you. Some of you will not be comfortable with that approach. Maybe patience is not something that you're rewarded with in spades. And it's part of the reason that we advise all our students to start with the psychology module. I know some, and we've had some comments about it quite interestingly, that people look, oh, have I got to start with psychology? And then they realize why they've got to start with psychology. Because if you understand yourself, you understand the good and bad, what your strengths are, what your weaknesses are, you play to your strengths, you're aware of your weaknesses, you find out what works for you, you develop your tactical plan accordingly, you will stand a much, much greater chance of success than if you're trying to do something that you're not comfortable with, you find goes against the grain. Can't stress it too strongly. So you've got to understand yourself. It's why we I don't say we insist, but that's the recommendation we put on the program, that you start with the psychology. It's a big module. There are 8 PDF downloads associated with it to help you. There's an analysis that you do of yourself. You get a full report, and it gives you a complete understanding, so you understand who you are and what you're trying to do as a trader and what will work for you best.
Okay.
Let me pause there.